Hi guys, welcome to our next session for our course. Hope everything's been going well for you so far. If you've got any questions, as always, please contact me. A few people have done that, which has been fantastic, and we've been able to sort out a few problems for them pretty quickly. Okay, so what we'll be doing today is we'll be having our lecture as usual. Okay, so just give me 1 second and I'm going to share our screen. There we go. All right, so today we're talking about managerial accounting and financial management in sports administration, and we're up to week 7. Okay, we're going to be looking at a few different things. We're going to be looking at budgeting, variance analysis, some costs, and a few different things like that. Okay, so it's going to be a fairly interesting session, this one. All right, so cost accounting. So far, when we've talked about accounting, we've been talking about financial accounting, which is what the accountants produce for the people outside the organization. Okay, cost accounting is usually associated with internal use of information. Okay, so it may come in a little bit of a different form, or it may be tailored so that the people inside the organization know exactly what the information is. It helps them make better decisions, would be a better way of expressing it. Okay, so cost accounting measures and reports information related to the cost of acquiring and utilizing resources. Okay, it can provide information for financial accounting because it's going to give us some information on what is the value of inventory if we're an organization that builds things from scratch, but it's probably got its biggest benefit for management accountants and management of the organization. Okay, so cost management describes the approaches and activities of managers in short and long run planning and control decisions, because they have to understand their costs, because if you don't understand your costs, you can't manage your costs. Okay, hopefully these decisions that they make increase the value of the customers and lower the cost of products. So they're doing things more efficiently. And what they're trying to do, what every organization is trying to do, we don't want to spend money unnecessarily. We don't want to spend money fixing a mistake because customers don't value that. We only want to spend money on things that customers value. Okay, so cost management is going to be an important part of a company's strategy. Now, this is really relevant for us at the moment because there's been a lot of talk in recent times about the NRL and the fact that they're burning through about $500,000 a day in costs. Obviously, they've got to have a reappraisal of their cost management, because one would, just looking from the outside in, it seems as though their costs are far too high relative to what their revenue is. They should be having a nice surplus which they can put away for the future. So the cost is incurred when a firm uses a resource for some purpose. Usually we assemble the costs into meaningful groups called cost pools. So it could be the type of cost or the source of cost. Anything that changes the level of total cost is called a cost driver. So the number of units of production could be a cost driver. So the more you produce, the greater your costs. But a cost object is any product, service, customer, activity, or organizational unit to which we assign costs. Okay, so a cost is a resource sacrificed, something incurred to reach a specific objective, whether it's making something, delivering something, providing something. A cost object is any product, machine, service, or process for which cost information is accumulated. So a cost object could be holding a special event. A cost object could be holding the grand final. What are the costs that go into that? But cost objects can vary in size from an entire company to a division, program, or even just one single product. How much does it cost us to produce one unit of that item? Now, when we talk about costs, there's two types of costs. There's direct and indirect. Now, direct costs are the costs which relate to a particular cost objective, and we can easily trace it. So, for example, if we're making bread, a direct cost may be flour. The more bread we make, the more flour, okay? Now, an indirect cost, that's a cost which is harder to trace. Yes, you might be able to trace it, but the cost of tracing it may not equate with any type of benefit, okay? So indirect costs are basically allocated. So we might have things like electricity for the factory, and we might just say that a small portion of our electrical bill is applied to each unit that is produced, rather than trying to work it out, you know, does this unit have 1 cent more than that unit? And it just might not be feasible to be able to allocate it in that way, okay? So like I said, we've got cost drivers. They're the things that drive costs, okay? A factor which causes the amount of cost incurred to change production costs, okay? It could be driven by the number of products produced. So labor costs, the more you produce, the more labor you need. Other drivers could be the number of setups. So if you change a product, you might have to set up a new production process for this week, or if there's a change in order. The one thing I think is really important, guys, is the fact that we've got cost reduction. Now, cost reduction programs are going to focus on two things, okay? We've got to make sure that we only expend money on things that add value. Who do they add value to? The customer. Does the customer like a new design that's better than the alternatives? Yes, they do. Does the customer want to pay for the fact that, you know, your warehouse was lazy and there was a lot of damage to equipment? No. Cost reduction is also about understanding your cost drivers, being able to manage those cost drivers, and as a result, understanding what the value-added activities are. Now, one of our financial statements that we often talk about is the statement of cash flows. This explains the current balance of the cash and cash equivalents line in the balance sheet. Okay, so last year's cash at bank will be the opening balance. This year's cash at bank, or cash and cash equivalents, will be the closing balance, and the difference, either increasing or decreasing over the year, will be explained by the cash flow statements. It helps us identify differences between if there's a surplus or a deficit. Obviously, being able to generate cash flows is important, because at the end of the day, we need cash to pay our bills. We can't just keep racking up bills and accounts payable and not paying them. So cash flow information gives us a good piece of information about short-term liquidity, which is the ability to pay our bills in the short run, and long-term solvency, which is our ability to pay our bills in the long run, okay? Cash flows are used heavily in finance as well when deciding whether to invest in a project or not, okay? So when we think about costs, another important consideration is the fact that some costs are variable, i.e. a cost which is a constant per unit, but changes in total in production to changes in the output. So let me explain an example. Just say I owned a bakery, as I increase the number of loaves of bread that I bake, okay, I'm going to increase the amount of flour I use. So that's a variable cost. It increases as I change the number of loaves of bread. A fixed cost, this is a cost which does not change as the volume changes, okay? It says it changes the per unit basis. Well, the more you produce, the lower the cost per unit. But a good example with our bakery example is that they've had to rent a shop to be able to bake their bread. And it doesn't matter whether they bake one loaf a day or 1,000 loaves a day, the rent is going to be still the same. So the Coastal Jellyfish AFL Club are considering raising funds by running an evening of entertainment where one of the players is seated at each table. The expected revenues are as follows. They expect to have 300 tickets sold. Okay. The price per ticket is $110. And the cost, so this first one is going to be a variable cost. So it's $30 per ticket sold. The more tickets they sell, the more those costs in total. The fixed costs are $21,000. It doesn't matter whether they sell one ticket or 1,000 tickets, it's going to be $21,000 for the venue and hire and band hire. Another important concept is what we call the break-even point. It's the point at which a business or activity within a business does not make a deficit or a loss, is called the break-even point. So it's the point where you're not making a profit, but you're not making a loss. It's just where you're breaking even. So this is the worst case scenario. And obviously you don't want to run an event if you're going to end up below the break-even point, i.e. at a deficit. So let's have a look at an example here, okay? So we know that the selling price of the ticket is 110 minus the variable cost per ticket, which is 30, minus the fixed costs should equal to 0. So 110V minus 30V is 80V. Now this is showing minus 21. If we flip it to the other side of the equation, we'll end up with 80V is equal to 21,000. Divide both sides by 80 and it tells us we need to sell about 263 tickets in order to break even. So what's the use of this break-even analysis? Well, maybe if we think we can only sell 300 at a maximum, but we need to sell 263 tickets, probably means that if we do sell the 300, we're not going to make much of a profit, does it? Or maybe we've priced them at a cost which is just too expensive given the fixed cost. Maybe we might need to consider reducing the cost of the tickets and hopefully selling more. So break-even analysis can help us with price setting, what our target for volume should be. If we don't think we're going to sell 260 tickets, we shouldn't bother. And it can also help us in ways to reduce or remove fixed costs. In that example there with the AFL club, it seems that given everything, the fixed costs are probably too high. They might need to find a cheaper venue. Finally, economics is the study of how individuals and economies deal with the problem of scarcity, scarce resources. As a result, people have to make decisions amongst choices, competing choices. The opportunity cost of any alternative is defined as the cost of not selecting the next best alternative. Okay, so suppose you own a building that's worth 100,000 today and it's expected to be worth 100,000 1 year from today. If the interest rate is 10%, what is the opportunity cost? Well, it's going to be 10,000. That's just a nice simple example. Of course, So guys, I'm just going to stop that share. Hope that was of some use to you. Fairly straightforward lecture, but it's really important. A lot of businesses fail, especially small businesses, because they don't understand their costs, okay? They don't understand the difference between, say, fixed and variable costs. They don't understand the difference between cash flow and profit, things like that. And I've seen that many times. So I'm glad we're covering it in this course, because when or if you decided to start your own business, hopefully you're going to have some sort of appreciation of what we are talking about. So guys, I'm going to leave it there. I hope that's been of use to you. Okay. If you've got any questions, please get in contact as per usual. And as always, have a great week. Okay. Thanks very much, guys.